I think I was asked in January, February this year what my prediction was for the end of 2025, and I said $40, or at least I think I said $40, and we blew through that like butter. I think we're going to see new highs. I think we're so close to $55 last week that the market just had to kind of do one more sell-off to drive it down a little bit, and it's destined to go through new highs here, and whether it hits 60, 65 by the end of the year, I wouldn't be all surprised.
Silver is not just rising, it is breaking the models that analysts and institutions have relied on for over a decade. For years, the consensus narrative was that silver would lag gold, that it would remain suppressed under the weight of paper markets, that it could not sustain a breakout above the 2011 highs. But that old playbook is dead. What Keith Neumeyer is describing here is not a normal rally. It is a structural repricing of a metal that the world has underestimated for far too long. A metal that governments now openly classify as critical. A metal whose supply chain is cracking under demand that is no longer speculative, but industrial, strategic, and global. Neumeyer lays it out with blunt clarity. His original call for $40 silver by the end of 2025 has already been obliterated. Not gradually, violently. Silver pushed into the mid-$50 range, sold off briefly, and is now positioning to challenge all-time highs again. But what makes this moment so powerful is not the price action itself. It's the reason behind it. The last major silver spike, the 2010 and 2011 run, was almost entirely driven by paper shorts being forced to cover. This time, Neumeyer says, the rocket fuel is coming from the physical market. The United States officially labeling silver a critical mineral was a psychological turning point. It lit a fire under institutions, mints, refiners, and strategic buyers who suddenly realized the world cannot function without silver. Not its energy grid, not AI, not nuclear power, not data centers, and not the electrification of transportation. Silver inventories are collapsing. Shanghai warehouse levels have fallen back to 2015 lows. Global deficits have stacked into nearly 1 billion ounces over 5 years. And while miners can pull about 850 million ounces out of the ground annually, the world is consuming more than 1.2 billion. That gap is being filled by investment stockpiles and strategic reserves, the kind of supply that eventually runs out. Silver is not just in a bull market, it is in a structural shortage that can only be resolved with much higher prices. And today, we're going to break this all down using brand new analysis from Keith Neumeyer and a full technical roadmap from Gary Wagner. If you value videos like this, deep, data-driven, non-sensational, but urgent, please hit the like button so this reaches more people. And make sure you're subscribed with notifications activated. We appreciate the support and hope you enjoy the video.
What caused that last move, the last leg higher, the last 25%?
Yeah, it's different because, I remember the move, that took place between 2009 and 2011. And, when silver broke out, through $30, back in early, I guess it was, early 2011, that whole move from $30 to $50 is basically short covering. The banks got completely caught offside. That was all paper driven. And that's why it ended so quickly, because it was driven by short cover. This rally that we've seen over the last few months is all physical demand. It's completely different. People are waking up. The United States government is deemed silver as a critical mineral, as you probably know. And I think that woke up a lot of people. And people are now saying, hey, look, this metal is really, really important for things like this. And we're not going to travel. We're not going to be able to drive. We're not going to be able to operate our homes or, whatever the case may be. Silver is a very critical metal. And people are waking up to that fact. So it's pretty exciting to see. It happened a little more quickly than I would probably liked, because it did get a little bit parabolic, and it needed to see a correction, and we're seeing that now. But it's going to settle, and who knows what we'll end up with at the end of the year, but likely higher than it's currently trading.
Silver usually outdoes gold here. It hasn't.
Yeah, well, the central banks have been really the driver behind the gold price, and they've been in the market now for a couple of years, and they're just buying a whole bunch of gold, as you know. And so silver took a little bit of time because, people were waking up to gold and seeing it, hitting new highs all the time. And, what's the brother to gold? Even though I don't look at silver as I do look at gold, I think they're totally different. I look at gold as a currency. I look at silver as an industrial metal that's required for all the things that we need to do, electrifying the plant and so on and so forth. So I treat them differently, but the market woke up to it. So it was quite exciting to see.
Absolutely. There was talk about a silver squeeze just about 10 days ago or so. You run a mint as well, so you, of course, and you're a silver producer, so you have all the insights here. But what did you see behind the curtain? Was it just a supply chain issue? Was it a logistical issue? Or was there a proper squeeze going on?
Well, I think it started with the tariffs, going back when, during Trump, when Trump was talking about tariffs in the U.S. And so a lot of the metal moved from Europe to New York or the United States, COMEX or whatever. And that included silver as well. And then all that had to be unwound, quite quickly, because all of a sudden the London market starts to get issues with deliveries. And interestingly enough, if you look at the Shanghai numbers, and because I see the Shanghai reports every week, and Shanghai warehouses are now down to 2015 levels. Which is crazy. So, this silver is being consumed in industry and is being moved around, and it is a bit of a bulky metal, and but it does get consumed, and that's different, as I said earlier, than gold, and because you don't recycle cell phones, you don't recycle computers, a lot of this silver that we consume just gets thrown in waste dumps. And it's getting a real problem, and we've now had 5 years of deficits in the silver market. The deficit on a combined basis over that period of time is close to 1 billion ounces. The miners are only producing about 850 million ounces a year, and we're consuming like 1.2 billion. So these ounces are coming from somewhere. They're coming from investment hordes or governments, but that's going to end, and we have to see higher prices too. And I've said it a dozen times to get the miners, the mining companies, to start producing more metal to fill that gap. But we're not going to do it at $50 silver.
Has silver demand geographically changed? Like, is there a new buyer in the market? Like, I've been reading quite a bit about India as well. Are they substituting gold for silver as well? Is that a new trend?
Yeah, I saw a stat, and you probably see the same stuff I see, and I think there was like 75 million ounces of silver or something shipped to India over the last couple of months, which is quite amazing when you're only producing 850 million ounces a year. So, but it's all industrial. Like, you just look at AI, for example. You're building all these data centers. How are you going to do that without silver? The nuclear renaissance. And now governments are talking about turning back nuclear, back onto the grid and building new nuclear plants. I think there's something like 30 nuclear plants planned for. There's a major announcement that came out of Westinghouse, just recently.
$80 billion deal with the U.S. Department of War, I believe it was.
Yeah. So this is exciting stuff, and these nuclear power plants require silver. They're not going to operate without silver. I think I was asked in January, February this year what my prediction was for the end of 2025, and I said $40, or at least I think I said $40. And we blew through that like butter. I think we're going to see new highs. I think we're so close to $55 last week that the market just had to kind of do one more sell-off to drive it down a little bit, and it's destined to go through new highs here, and whether it hits 60, 65 by the end of the year, I wouldn't be all surprised.
What Neumeyer reveals here is the most important distinction in the silver market since 2011. The last major run, the one that took silver from $30 to almost $50, was purely paper, a massive short-covering panic when banks were caught offside. That rally died quickly because paper demand can vanish overnight. But this time, the banks aren't trapped. The world is. This rally is being carried by physical buying, from governments, from industrial consumers, from nations repositioning for geopolitical competition, and from a public waking up to how essential silver has become. Prices must rise, dramatically, or the world simply runs out of accessible metal. Neumeyer is clear. $50 is not enough. Even $60 is not enough. The mining industry cannot expand production at current price levels. Only a sustained, structural revaluation of silver will keep the system functioning. Now let's move to the second major clip, where Gary Wagner applies technical precision to everything Neumeyer is warning about.
The facts are the facts.
Yeah.
Resistance at just below 5400 was absolute. You've got this double top. So that's the mark you've got to beat. That's also a new all-time record high. It's the first time that silver's actually done that. We've seen gold, I don't know how many times it's hit new record highs this year. I think it's around 27 or more. I could easily be way off of the mark. But what I do draw your attention to are these two moving averages. The 50-day is in green. That is what most market technicians view and use as a line in the sand as to whether or not stock or commodity, in this case silver, is in a bullish or bearish trend. And when we look at it, there's an instance in August, but for the most part, really since May, it has been above the 50-day moving average. The one in purple is a shorter term 21-day. They're both simple moving averages. They're not exponential. And so you can see that we've had lows that have come near here. This will be an important level to hold, 4,900. If it breaks that, the critical level to hold will be $47 per ounce. And it kind of matches roughly with this low here at 46. As long as it remains above these moving averages, it's simply a market that's moving up and correcting before moving back higher. The only thing that's really different when we think about the gold chart that we looked at and compare that to what we're seeing in silver is this is clear as day, a double top. And so a double top signifies a pretty strong indication, because for a market to come up to a certain point, that's a new all-time record high, and come down, find support, and then move up, isn't telling us that much. But when it comes up to that same point and once again begins to fall, and now it's the third day, so it's more than a single day, doesn't mean it won't find support at 49, does not mean it will not find support at 47, but it brings into question whether or not we're looking at an absolute top. It is an all-time record high. Gold's all-time record high has not been challenged twice. It made it, and it's been below it ever since. Silver finally did something unique in its own price structure. It broke well above 50, which was the former level that we all looked at. It went higher than 53. We are looking at futures, so that's a little bit above spot. But the bottom line is there is a double top. We've seen 3 down days, but now we're at critical areas that are important to watch. 49.20 and 47. Those are price points that if it holds, we can easily make the observation that silver is still in a bullish demeanor. If it breaks below the 50-day, we can no longer say that with confidence, because the chart, the numbers don't agree with that statement.
Give us a roadmap for Q1 of 2026. I mean, is there any specific price targets that your model kind of projects once this correction concludes? I mean, are we talking 5,000?
I am searching Q1 for 4,500 if in fact we are witnessing a true and simple correction and not a pivot from bullish to bearish. I can't make either statement with confidence because there's just not enough data. I can say with confidence that after hitting 4,400, an all-time record high, it made a very acceptable correction just below the 61.8. In other words, went to 39, excuse me, and then popped back up. The fact that it made a lower high is challenging to make the assumption we are still in a fully bear market. What would make it a bear market? You've got an all-time record high. You come down, you form a base at 39, you make a lower high. If we make a lower low, that puts a lot of ammunition into those that say, well, we've pivoted from bull to bear. Until that happens, we can't make either of those statements, I'm sorry to say. And I'm basing this simply on the chart. Of course, it's going to depend on the fundamentals at play. And that I wouldn't even venture to guess what that could be. We don't have crystal balls, and when we do, they usually are just real cloudy. What we can say is that gold needs to hold above 39.30, 39.40 to 50 on a technical basis. If it does, we're still fully bearish. I would, in a best case scenario, look for gold if it continues to go lower to find support at around 3,900. And then I would look to see if it can make a higher high than this high here at 4,200. If it can make a higher high than that, even if it's only to 43, it doesn't have to beat the all-time record high. That means that there's a really decent probability that the bull market is still in play. A move below 3,900 and continued downside would put less evidence to that fact. And obviously a break below, call it 37, 3680, would tell us we probably witnessed the best that we're going to see for a while. Doesn't mean it won't go back there in 6 months, but we probably won't see it through the end of the year or Q1.
What Gary Wagner's analysis shows is that Neumeyer's warnings are not philosophical. They're visible directly on the charts. Silver is behaving like an asset that has outgrown its old trading range. It broke long-standing ceilings, carved out a new all-time high, and is now testing support in a way that historically precedes explosive continuation moves. Meanwhile, gold is quietly confirming the same story: higher lows, tightening consolidation, and an underlying bid that refuses to break, even under heavy profit-taking. When both metals flash the same structure at the same time, it means the market is no longer trading sentiment, it's trading scarcity. And scarcity is exactly what Neumeyer has been sounding the alarm about. The physical drain, from COMEX, from London, from Shanghai, is the real engine behind silver's new trajectory. Wagner's charts are just the visual proof of what Neumeyer sees on the ground: inventories collapsing, premiums rising, and delivery demands accelerating. In other words, the fundamentals and the technicals have finally aligned. The last time that happened was the 2009 and 2011 cycle, and it produced one of the most violent vertical precious metal rallies in modern history. The difference now is that silver is entering this phase with a multi-year deficit and industrial demand that didn't exist back then. If Wagner's technical roadmap plays out, and silver holds the critical support zones he identifies, then the market will not only retest those mid-$50 highs, it will exceed them in a way that redefines the entire precious metals landscape. A breakout in silver does not happen in isolation. When silver moves, gold follows. When gold breaks out, institutions shift portfolios. And when institutions shift portfolios, the pressure on physical inventories intensifies. This is the feedback loop forming right now: shrinking supply, rising structural demand, and chart patterns that point toward higher highs, not months from now, but in the next major move. So as you watch both parts of this analysis unfold, Neumeyer's fundamental alarm and Wagner's technical confirmation, the message is unmistakable. The precious metals market is entering a phase that will not look like the last decade. These are structural changes, not temporary rallies. If you found this breakdown valuable, make sure to like this video so more people see it, subscribe if you're new here, and turn on notifications so you don't miss the next update. The next few months could be historic for gold and potentially transformational for silver. Stay informed, stay prepared, and thank you for watching.